What's up, guys? This is Apurva. I have my close friend, Sohail Hassan, with me. He has built an incredible private equity firm with all facets of real estate, different asset classes. I'm excited to kind of take deep dive of it all. But just to start us off, bring me to the recent future. Like,
Sure. Really, I'll tell you, Apurva, what led me to real estate is understanding the tax implications, right? Because here I was in a position where that was exactly going to be the case for me.
Yeah.
So trying to understand where the best investments that I can make in order to create, basically tax shelters, right? So that I can avoid having to pay unnecessary taxes. And so that led me down the route to being introduced to a former roommate of mine from Texas A&M who was in the real estate sector. And when I met with him and told him that this is what I was looking to get into, he introduced me to two gentlemen who are my business partners today. One is a gentleman named David Rodarte, who has been working in real estate his entire career. He really focuses on the construction and renovation side of the business.
Okay.
And then our chairman of the company is a gentleman named Dr. Masaki Oishi, and he's actually a practicing neurosurgeon here in the Houston area.
Wow.
And in addition to, of course, practicing medicine, he has been an avid investor in real estate since really he was the age of 16. His parents immigrated to this country from Japan, not speaking English very well. He, of course, and I always make the joke, it's like very Asian of his parents, right? To like make his son start working. So he managed like the entire property management side of their business. So really started learning that and then put himself through med school and has always been investing. So David and Dr. Oishi met in 2011.
Okay.
They made their very first investment into a multifamily property here in 2012 in the Houston area. And that property was the Parks on Eldridge, right off of I-10 in Eldridge.
Great
So they
property.
bought that property and operated it, and started buying retail, shopping centers, office buildings. And then when I met these guys, that's when they really, they were doing these as individual investments, right?
Right.
You really using kind of their own money. But that's when we decided, they wanted to create a company and actually a private equity firm that pursued this. And so that's essentially when MarketSpace Capital was formed back in 2017. So since then, we've been doing all of our investments underneath this umbrella company, right? And really, I will say at that time, Apurva, we took a more disciplined investing approach, right? Seeing what was going on in the market with big box retail kind of going out of business, as well as how in terms of being hyper local to the Houston market, how that's being impacted with the oil and gas sector. We really started deviating away from retail and office and started exiting and divesting out of those in our portfolio and taking a full laser focused approach on the multifamily asset
And this was
class.
Pre-COVID.
This is pre-COVID,
So
yeah. Actually, this decision was made right pre-COVID. And I'll tell you, Apurva, we exited our second to last retail shopping center as we had 4 in our assets, right? So we sold 3 of them, and the last one closed a month before COVID hit.
Wow.
So, and we really felt it. The last one we had, during COVID, we had tenants that didn't pay their rents. We had to come in, we obviously have to kick out of our own pockets.
Right.
And so we really felt it there. Whereas on our multifamily properties, actually that year we had our best year of rent collections, right? Year-over-year rent collection. And of course we attribute that to, stimulus money and things like that. But ultimately, it's psychologically, it comes down to, people know that rent is due on the 1st. Yep. And that their living is going to come before anything like their office or retail.
Shelter. Yeah,
there you go. So that's really reinforced our investment philosophy and why we've really kind of doubled down and just focused on the multifamily assets.
So let's unpack it a little bit.
Sure.
Incredible journey. I mean, you've got, the heads of the fund, you've got medical, you've got a real estate guru, and then you've got somebody with a political and startup background. I mean, I couldn't pick a better recipe, right? In terms of like putting a team together, like you're the Avengers, right? Like it's amazing. So that's awesome. So like, let's unpack. So you guys kind of shifted away, or it was part of they already had exposure, it sounds like, to retail and office and things like that. Was just kind of what they were doing.
Yeah.
And you guys put your heads together and said, hey, maybe multifamily is where we need to start focusing somewhere along that journey.
Yep.
And MarketSpace Capital was one of the pieces that kind of that's the overarching company, right? So how many doors are we at today?
Yeah.
Share as much as you can. What do you think roughly the value, if you're willing to share,
sure, of course,
of that portfolio? And then I want to talk about building a private equity firm, right? Because that is not easy.
Yeah.
A lot of people, first and foremost, like just acquiring these large pieces of real estate, I believe is almost always done through private equity, right? Almost always, right?
Yeah.
Unless you're a big institutional like investment bank or something like that, right? Like it's your type of companies that come in and take down these large parcels, right? And so, but it starts with zero, right? Like how did that happen? How did it come together? So I want to unpack a little bit, but let's start with where you're at and then we'll kind of go backwards.
So today we have broken up our company into 3 different verticals.
Okay.
The first vertical is of course our value add strategy. And our thesis is quite simple, right? We invest in Class C to B conversions.
Okay.
So we're investing around $75,000, $85,000 per door with the idea that once stabilized in 4 to 5 years, that asset will be worth around $120,000, $125,000 a door.
Perfect.
Right? And we have rinse and repeat this time and time again. Starting from the days of when Dr. Uishi and Moss did this with Parks on Eldridge in 2012, we have basically used those same fundamental principles and have replicated it over and over.
Love it.
We've done a total of 24 investments to date. We've gone full cycle on 16 of those investments.
That's awesome.
And again, the model is acquiring them. Typically we'll see that they have like 90% occupancy, but really, they're collecting about 50, 60%
like
rent.
The economic occupancy.
There you go.
Well.
So immediately we come in and our job is to clean house, right? So first and foremost, it's understanding, those who are on hard times and working out payment plans with them. I'll be honest, some of them are just looking to scam the system, right? So whatever the case is, first we have to phase those out and immediately we start focusing on those units to renovate. And, depending on where the property is located, we basically do a market analysis and we understand that, okay, if we do granite countertops, that we'd be able to get yield X amount in rent, right? Now we're always very conservative in that underwriting.
Sure.
And I'll give you an example. There's 2 assets that we own that are right across the street from each other in Greens Point, Houston. And Greens Point is a very difficult area of town.
Not Class A.
Yeah, it's not Class A. So, we came in and we essentially bought these 2 assets. One was getting 94 cents and the other one was getting 96 cents per square foot respectively, right? We basically came in and showed our underwriting model that after doing some modest renovations that we would be able to get $1.04 and $1.06. What we're actually getting in the market today, Apoorva, is right around $1.26.
Oh, that's awesome.
Right?
So we only did a 10% roughly bump.
Correct.
But you're landed at 2025.
Yeah, exactly. Awesome. And so we underpromise and overdeliver. That's the idea because whatever we hold in that OM, we're really kind of putting our name on. So we want to make sure we're very conservative in our underwriting. And so that's essentially been our model, right? Now I'll tell you, we've had, in terms of the exits, like the NRG area of Houston, that's where we really focused on. At one point, we owned 5 different assets. We started investing in that area around 2018, 2019.
Okay.
So at some point, we owned 5 different assets. Each of those assets, we bought in around 85, 87,000 per unit. They're all built in 1979, things like that. So at one point, we owned 1,512 units in that entire area.
Wow.
And when I say NRG, you're exiting Kirby, you hit the light, there's
the Texas Stadium.
There's a light there called Westridge.
Yep.
If you make a left on that light, there's a lot of Class C apartment complexes. So we actually started investing because we understood that the highest and best use for that land is not Class C apartment complexes. So, using our political connections and things like that, we were really trying to go after that to do a large redevelopment here. But ultimately, that property, because of the expansive growth of the Texas Medical Center, that property is just increasing in value. And so we had an offer last July. We basically had someone from out of town came and made an offer to buy it at, 121 per door, right?
Wow.
So it's a $53 million acquisition, a $75 million exit, right?
Wow.
And so that kind of shows you the exact model there, what we seek to do in these assets, right?
Love it.
Now it started small, right? At Provo, we started doing it with our own money. We got to a point where we felt comfortable in our financial model. We started bringing friends and family. And then, I always say that at this point today, we're to a point where we're attracting, we're sophisticated enough to be able to start attracting institutional capital, right?
That's awesome.
And so that's where we kind of land today.
So I'm going to pause right there. For anybody that's kind of wants to go on a similar journey, like, what you've done at, a reasonably young age is freaking impressive, right? So like, yes, you kind of partnered with some great players to help kind of rise, your journey quickly, right? Which is amazing. And that's also something that the people should think about, right? Seek good, seasoned advisors, mentors, and partners and vetting them, for their track records and things like that. But not to diminish what you've accomplished as part of the play. So you have these great partners. The very first capital raise, right? Let's talk about that for a second, because that's daunting. You're talking about raising millions of dollars, right? And maybe just, maybe your personal track record wasn't there in this thing, right?
Sure.
So like, or in this kind of category of effort. Let's talk about that. How did that go? How did it feel?
Yeah,
what are those what are those
so
pitches like? It's clear the political background helped.
Sure.
The messaging, like you mentioned,
Sure.
right? Like you can tell a good story.
Well, I'll tell you the real marketing. So when we sat down, and my background, as you know, with my brother, our family, it's really on the marketing side,
Yeah,
right? It's like
yeah.
understanding the elements of that. And so, sitting down with our team, we really understood that our ideal avatar of an investor is a physician, right?
Okay.
Because they're, high net worth income, they understand that they should be diversified in their portfolio of investments, and so real estate should be a part of that.
Right.
But they don't have the time or the resources to really,
Correct.
investigate that. Furthermore, naturally, since my business partner is a neurosurgeon,
Yes.
it made sense for us to really cultivate that kind of that funnel.
Makes sense.
So that's exactly what we did. We basically created a funnel out of this.
Love it.
And Dr. Oishi authored a book called Prescribing Real Estate.
Oh, cool.
And it's a medical professional's guide to investing in real estate.
Love that.
And that is what we use at Apurva in the business as what is known as a lead magnet, right?
Yep.
We basically give away digital copies of that book for free. And so imagine we've created a funnel there, right?
Yep.
And I'll tell you, to this day, the most, and this is what I think is your listeners, hopefully there's some tips that they're
Yeah, I
out
hope
of this,
so, yeah.
but is
Love
really creating our LinkedIn campaign. So imagine this: we use a tool that automatically adds, a different amount of connections through Dr. Oishi's account
Yep.
on a daily basis, right? On some days it's like 30, some days it's 10, right? So it fools kind of the algorithm.
Love it.
And then once they add as a connection, it sends them a messaging campaign. Now the copy of the messaging campaign is very attractive. Might I say that I wrote it myself, but it's specifically along the lines of, I think I've known you from the wide world of medicine.
Yeah.
My name is Dr. Oishi. I'm a physician, but I'm also an avid real estate investor. In fact, I've written this book to educate others, and I'd like to give you a free copy.
Love
Can I
it.
get your email address? Every single day we wake up, we have 4 or 5 little leads that came in.
Love it.
Now all of that goes into a drip campaign, and of course the very first email is a copy of the book. But then every subsequent email after that is really providing them value, right? It's breaking it down in a very simple way. 4 ways that real estate investors make money through real estate. Tax strategies, right? Breaking it down with the idea of converting them into an investor consultation.
Love it.
Once that investor consultation happens, that's meant for us to do an introductory call.
Yep.
Now, even in that call, we're not pitching an offering. That's a call where we just get to know each other, tell them the origin story of the company, really relate to them, right? Answer their questions, how our investments are structured, right? And all of this has been scripted, right? Down to the T, every single word.
Yeah.
And once we have done that, then that's when we start introducing them to offerings. Now, clearly there's a due diligence package that we make available to them as well.
Right.
That includes 2022 in review and the history of the company, track record. That's what everyone wants to see,
Yeah, of
right?
course.
The numbers. So we have that broken down very easily for them to see. Then some of our, we've documented every part of our process, right? So from our investor onboarding to what the investors can expect from us. So we provide them kind of a document, how they're going to get quarterly reports, and we give them examples of those quarterly reports that we do on some of our properties. So they get all of that information, and then that's once they start feeling comfortable, that's when we start really giving them, these are the available offerings that we have, right? And then we go into some of our value add, our ground up, and then of course our mixed use project, which I'll get into in a moment here with you. But through this funnel, Apurva, today we have about 4,800 accredited investors that are made up in our network, of which we've converted about 450 to actually invest with us. So
awesome.
Right below 10% conversion rate, right?
Yeah.
And every day we're doing what we can to improve that conversion rate. Right. But ultimately, that's what we've been able to actually deploy into our thing. And I'll tell you, Apurva, we're blessed, man. Last year, we raised and deployed $58 million of equity, right?
So I was going to napkin math. I'm an average investor check, 100, 200K.
Yeah, so
roughly?
about $250,000 is the average investor's thing. And, our average hold period, even though we show 5 years as on all these multifamily deals, has been 2.5 years. Right? Because our model is very much like acquire the asset, stabilize it, start renovating it. And then we don't even renovate all the units, right? Because we want to leave meat on the bone to show that the model's been proven for the next guy. And then they come in, they take it over from us, and then we exit the deal.
I love it.
That's essentially the model.
So we broke down that first prong, value add, Class C multifamily.
You got it.
You got
2,400 units.
2,400 total units
Total
today,
units between
currently.
Houston and Dallas.
Got it.
Right. And as I mentioned, our last exit was just during the height of the cycle. Can you imagine July of last year during all of the chaos?
Right.
Now, these days, deals, obviously with increased interest rates, aren't penciling out as much. Although I'll say we are going after those compelling opportunities.
Yep.
Our latest closing was in April of this year, and that was for a 122 unit multifamily product that's located in Fort Worth, Texas.
Okay.
Right. And this is like the perfect story you like to see in real estate, or, it's like, unfortunately a guy passed away. It went to a family trust. Family trust hasn't been doing anything with the property for the last 5 years. And, the average rents at the property are $650, while the area, the market is like $950.
Yeah.
So we, at the height of the cycle, they were looking for 85 per door. Apurva, we put it under contract and closed for 69,000 per door.
That's awesome.
That property is already cash flowing today from, owning it just in the last several months. We have 91% occupancy. Everyone is going to the renewal rents. As the units become available, we're renovating and getting even higher rents.
That's awesome.
So it's like the perfect story that you like to see.
So you touched on your investor capital raising funnel.
Sure.
Freaking awesome, by the way. I'm like,
Thanks, man.
mind blown. Love it. Let's talk about acquisition funnel.
Yeah.
Like the deal you just mentioned.
Yeah.
Those things are not easy to land,
Sure.
right? So you need, I'm assuming, some type of machine running.
It is,
from
yeah.
acquisition.
So I'll tell you, there's two ways of doing it. First and foremost, I'll say the traditional organic way of doing this is, the old-fashioned through relationships.
Yep.
And I will say that we have deep-rooted relationships now with brokers in the industry,
Yep.
particularly here in Houston, Dallas market, where we spend a lot of time. We have offices, we have employees. So, it's wining and dining them,
Yep.
doing that part. And that's how we really get a lot of these good deals. So the stuff in NRG that came,
Yeah.
and even the stuff that came from Dallas, that all came through a network that we had already established. The other one is that, we would like to see a consistent deal flow coming towards us. And it didn't make sense for me to do this internally. We have provided like standard operating procedures internally. Like basically I have two guys, one as we see a property that comes in, one is doing a underwriting analysis and the other one is doing a market analysis. If this passes them and they think that this is a good investment for us, then they put it forth to our investment committee. The investment committee is made up of the partners,
Right.
and then we review and we debate this thing out. It'd be a very heated meeting,
I
right?
believe it, yeah.
And then we come out of those meetings deciding if we want to move forward with it or if we want to pass, right? I'll tell you, for our rate, we're looking at like hundreds of deals, right?
Yep.
Like our thing is like building up the data. Even if I'm not passing on the deal, I just want to know what's happening in the market, and so I put that deal into our database, right?
Yeah.
So we're looking at like hundreds of deals, underwriting, seeing what things traded for, just to see from their underwriting what these other sponsors are thinking, But once we take that in, of those deals, I would say about like 10% actually get to the investment committee, and of those, like 3%, right?
Yeah.
So we're saying like of a deal, I want to say we went through these numbers just of last year. So we had looked at something like 300 deals, and of those 300 deals, something like 22 of them went to our investment committee,
Yep.
and of those 22, we ended up moving forward with like 5 acquisitions, right?
Got it.
So that's kind of how it breaks down in terms of that. But once we see those deals, it made sense for us to outsource it. So there's an organization called Offered.
Okay.
Offered is, they basically came into us, and what we do is they also have a database of every multifamily property, and we tell them the parameters that we're looking for. Class C, this price, this area.
Got it.
They then basically take that, and then they will start making, they have a 6-pronged marketing strategy where they hit up those owners through direct mail, through email, through, and they basically make an offer on our behalf. Once that offer comes into where they think it's good for us, they'll bring it to us and they say, okay, are you guys ready to move forward with this?
So it's like a tech-enabled brokerage.
There you go.
That's awesome.
Outsourcing the brokerage.
That's
element to
awesome.
them.
That's awesome.
So now they are bringing us deals constantly. You have to pay them for this fee, but they bring us deals constantly, right? Stuff that we never saw. Things in like Austin, like deals that we would have never had opportunities to come
Yeah,
could have come
gotten
across.
access to even.
So
Yeah.
they bring it to us, and then it goes to our guys who underwrite it. They see the deal. So there's like a filter before it even comes to my guys, is the point I'm trying to make.
Makes
to you.
sense. Yeah.
So that's kind of how we've created this flow. But I'll tell you, man,
That's
even
very scalable.
today. Yeah,
That's
It
awesome.
really is.
You've got this network of brokers,
Yeah.
right? And you've got this tech platform, which is effectively a tech-enabled brokerage,
Yeah.
right? And then you've got kind of relationships that are established by your team over time, right? And that's fantastic. fantastic. And naturally, a track record makes it easier to have those conversations and forge those relationships. And then you guys got an investment committee, and you guys, do the dance and decide if you want to do the deal. Then you're kind of making the offers, and then you're hopefully acquiring, right? There's probably a financing funnel, banking relationships, all that kind of stuff. Unpack that for a second.
Yeah, so we have two capital markets guys on our team. One specifically is dealing with the debt side, and then one is specifically dealing with the equity side, right?
Okay.
Both of them I'm overseeing, but we have a database, right? We know who's giving out. So if it's a multifamily of a certain amount, the smaller banks are pretty much ruled out on our business model entirely because these are Class C assets that are not stabilized.
Okay.
So immediately we're going, and we're typically used to paying higher interest rate, 9, 10% today, 11% in some cases, right?
Yeah.
But it's okay because the interest reserve that's required, we're raising that as a part of our equity. So we know that for the first 12 months, we're not going to be able to collect rent and meet our debt service.
Correct.
So we're raising that interest rate and we're keeping it there. So that gives us that 12 months of runway. Now, as through those months, it's important that a very critical model that we execute. We renovate the units, we do what we're doing, get people on board so that we can then refinance into a more traditional fixed rate. I'll give you an example, like the NRG areas, right? There's two properties, we own 520 units right across the street from each other. And we bought them at an 8.99% interest rate. This is like high. 2 months after we bought the property, someone was murdered on the property, right? So it's like, then we had to meet with the police chief and investigate all of that stuff. So these are really tough areas where we had to implement a crime eradication plan.
Wow.
Where and we're used to these types of properties, right? But we're not scared of those, right? Because that is, my friend, where the real value is. Right? We don't have other competition really that's competing against us for this type of property.
I was literally thinking in my head, I was like, I would be terrified of those type of deals, right? But you've got an appetite for it.
We know what we have to do, right? We immediately get our relationship with HPD. I'll give you an example. Right now, one of our latest properties is our last acquisition of 736 units that we acquired 2 properties in December of last year. Okay, and so we had 1031 out of those NRG properties, and of course we had to look for our next deal. So we found these 2 assets. So it was our largest acquisition to date, $77 million acquisition.
Wow.
And so in one of those is a 464 unit, and the other one is 272 units. That 272 unit is awesome property, no issues with debt, with rent collection. There's a waiting list of people to move in. That 464 unit, that's a beast. And that one, there's a lot of problems with, right? It's the same type of issue we had in the NRG area. But immediately we mobilized, and within 6 months of Prova, we've turned that entire area around, right? Installing new lighting, putting in proper security parameters. Initially we'll put in security guards, but then we start throttling them off as the security improves. Meeting with Houston Police Department, we got the MUD district to put a budget together to assign new additional police officers to this area. So that is real change, my friend. So that's why I believe what the impact of what we're doing is far outweighs just the returns that we're providing to our investors. We are literally investing millions of dollars to revitalize communities. Right?
Love that.
And then let me tell you, the other thing about this Prova is that we've added an element to this of sustainability, right? Given my background in renewable energy, that's always been at the forefront for us. So what we did is we went and partnered with another company. This company came, and I'll tell you, and we're spending a lot of time on the value add, so I apologize.
I love it though.
I'll tell you on the value add side of Prova, with today what we're facing, what all of the sponsors, everybody who's listening here is facing, is a very tough market. High interest rates, property taxes are increasing, insurance costs are increasing. So what I have challenged my team to do is look at other ways to generate ancillary forms of income. Okay. So that's everything from the credit card processing to the renter's insurance to the cable, the internet, and even the energy side. So what we did is we went and partnered with a company that came and they bought the energy rights to all of our buildings. Okay. They paid me $65 per unit per year to basically have the rights to go on our behalf and negotiate energy contracts. Okay. Not only energy contracts, but let's say the low-hanging fruit is like retail electricity, right? For every tenant that moves in, that's easy. But then they also do solar. We're putting solar system on our roof, and then they do what is known as demand response. Are you familiar with that term? No. So the solar system, the typical system is grid tied, meaning that as you're using energy in your home, your dishwasher, AC, all your grid is going clockwise. Now you put in a solar or you put in wind, and that's a grid tied system, all it's doing is it's taking that grid backwards, and you want it to go backwards as much as it goes forwards in order to achieve something called net zero. In this new model, what these guys are doing is, because batteries are becoming more inexpensive, instead of it being grid tied, these are tied to a battery system that's somewhere on the property. Now those battery systems are storing all of that energy, and it's attached to the grid. So now in the summer months, like these days where the grid is being exacerbated every single day, there are times where there's these events where the grid will say, okay, we need energy back onto the grid, and we'll pay you a exorbitant amount to do so. So at that time, these guys flip a switch, and now all that energy from those batteries get pushed back onto the grid.
That's awesome.
So it creates a revenue, monetize it. There's a revenue sharing component to that. So 40% goes to us, 60% goes to them.
Oh, that's awesome.
So we model this out. That's only one element. We talk about electric vehicle charging. Talk about thermostats. They put in digital thermostats in all of our new 155 unit property. They put in digital thermostats. So now we do demand response. We bring the thermostats up, then decrease
peak zones and things like peak zones.
Got it, man.
I love it.
So we modeled it out. It's creating an additional $24,000 per year per property by implementing in all of these things. Now, if you take the cap rate of that, I mean, you're talking about enormous value that we created for the next buyer.
25K.
So this is just an example.
$400,000 or $500,000 in value per property.
You got it.
I love that, dude.
So this is just the value add side, right? And what we're focused on.
And well, you've got this you got these parcels, and you're going to continue to scale and more units and more locations, and you can build this grid over time, right? I love it.
Yes, they're called virtual power.
Twice now you've blown my mind already.
There you go. And then we just started.
We just started. No, that's awesome, man. I love it. And again, kind of your background of kind of these different, levels of your career has given you these areas that nobody would have had, right?
Slumdog Millionaires.
I love it.
Somehow my background brought me into this situation, And I'll tell you, this is so, and to that same regard of us, the way that our company makes money is two ways, right? Through fees, such as acquisition or development fees or disposition fees. Of
course.
And then there's sales of properties, right? Not either of much is happening right now in this market.
Yeah.
So we really had to challenge our team to look at these other ancillary forms. And then part of that was also the construction side.
Yeah.
So we created a sister company within the MarketSpace Capital umbrella called CapEx Construction.
Okay.
And all of the, 18 months ago, we're having issues where, units aren't being turned in on time and they're really expensive. So we brought all of that in-house. And now we have an entire team, construction management, we have crews, we have a warehouse where we have everything you could think of for an apartment complex sits in that warehouse.
So let me ask you this. So, there's two sides of thought where maybe, as a sophisticated PE firm, like deep concentration on what you do best, right? And, it sounded like it started with this, sourcing and structuring and kind of executing on this value add multifamily was the first expertise, right? And then you kind of started adding other layers. There's a conversation, and a healthy debate here. Is it wise to add new kind of concentrations and kind of different asset classes and different strategies? Are you sometimes taking away from what you're at best? Or like for somebody like you guys, how do you stay effective in all the things you're trying to do, right? Because I think that's where I think sometimes, like for me, just a quick 30 seconds, I got out of single family and I focus now on self-storage. And that's all I want to do now. We only do self-storage, and I want to be really good at it, right? Versus the distraction, like short-term rentals and all these sexy real estate things that happen. I'm like, no, I'm not going to get distracted. I want to focus and get real depth. So like brokers are finally calling us back because we've shown track record of acquiring. Like we understand how to underwrite a deal in like 30 minutes, right? When I get the 15 pieces that I need to know to underwrite a deal, I know where I'm making an offer because we've just got depth now, right? And so for me, and maybe it's because we're too small today, I don't want to get distracted, right? But tell me like how you guys are doing that effectively.
Absolutely. So great question. And I think that, all of it centers around the component of multifamily, right? That is the underlying factor now moving forward in all of our investments, right?
Great.
And so understanding that on the value add side, it very much is a rinse and repeat process, right? From the acquisitions to even the asset management side, the teams that are working there. And, there are, of course, challenges, right? No real estate investment is easy. Every single one of them is going to have there, even from the smallest
There's
one.
no such thing as passive.
Exactly. So
unless you're an LP,
yes,
maybe, right? But other than that, no.
Exactly. Otherwise, you're actively involved in making sure that it succeeds. And so, we've gotten that down to a T, right? Ultimately, what reason we went into the ground up development side, and I think this is a great time to transition into this portion of our business, is because in order to provide those same returns that our investors were expecting in a market where sellers had unrealistic expectations of what their properties were worth, we naturally navigated towards the ground up development, right? Understanding that we had the team in place, the knowledge in place from the value add, that we would move into this next kind of phase of where the company goes. And I'll tell you, Apurva, this is a story that's been written many times.
Yeah.
I say this is the natural evolution, typically, of a private equity real estate firm, is that they see from the value add side, they've been able to get certain returns, but in order to maintain those returns, you really start navigating towards the ground up development side, right?
Makes sense.
And, we kicked off our first project, a garden style 155 unit multifamily project, ground up, and, found the site. It's near the Med Center. It's right near Post Oak, South Post Oak and Beltway 8, next door to the Yes Prep Academy. And I'll tell you, it's been a learning lesson, right? Every single portion of this project, what could have gone wrong probably did, right? We started the project and signed our loan 6 months before COVID started. The lender that we had was heavily invested in hospitality. 85% of their portfolio was in hospitality. They made the loan with us because they are now starting to diversify and get into multifamily.
Got it.
So of course, 3 months after COVID hits, they're like, hey, hospitality, we don't know what the future looks like right now. We're gonna basically pull out of this loan and we're not gonna be able to fund. They funded 3 draws. Mobilization, everything was starting, just getting kicked off. And then we had to go and find a new lender. So that took another 6 months of delay. Finally got our lender, end of 2021. We kicked off construction. The GC that we were using with, right? The GC kind of brought us the project. They're like, hey, we're not multifamily developers, but we have this great site, but we want to build it. So we brought them into the project. But, they started missing some deadlines and stuff. So we immediately fired them and we brought in another company, a friend of ours that owns a local company here. And we brought them in to fix and unwind their mistakes. And then now we're to a position where it's finally 60 days away from being completed.
Wow.
And as you, right before this started, I just showed you some pictures of the granite countertops, the doors, the lighting, all that stuff. But, real estate is such a beautiful business, Apurva, because here, I mentioned to you that in the NRG area, we just exited some of the assets that are around that 125 per door. These were built in 1979, Class C assets. So right down the street, 13 minutes down the road, I have a brand new built in 2023 asset. And so by that very logic, that is kind of increasing the value and demand of what we should be able to get for this. So, all in cost construction, around 160 per door at stabilized value. At CO, we could probably sell it for 180 upon stabilization, around 200.
You wanted to get out quick.
So even with all of the mistakes that could have been made in this project, ultimately because of real estate and the fact that we are invested in a hard, tangible asset that, the granite, for example, the concrete, all of that is increased in value. So therefore the project itself, the worth of the project is increased as well. And we are, of course, the beneficiaries.
Like a rare instance where inflation is working in your favor.
There you go.
Right? I love it.
So that's one project. We have another one in Dallas. So I'll tell you, Apurva, we started spending time in Dallas back in 2019.
Okay.
Opened up an office there, hired some employees, just because the data drove us there. Dallas is one of the best real estate markets in the entire country. The DFW area makes up the 6th largest economy in the country. So understanding that, we started spending some time there, and we came across a beautiful site that is directly adjacent to the Dallas Medical Center. When I say adjacent, it used to be a parking lot for the medical center. We acquired the site from the owners of the hospital, which is a REIT based out of Los Angeles. So we came in and basically are building 250 units. It's a 5-story wrap, mid-rise. It's what it's called the Texas Donut.
Texas Donut, yeah.
So it has a wrap pool in the middle and it has a podium-style parking garage. So where I told you our Houston project, around 160 per door, garden style, this one is around $280,000 per unit. So about a $68 million total construction cost.
Your parking infrastructure, everything just drives it all up.
There you go.
All the whole.
And it being in Dallas, right right off the freeway. It is off 635. There's 280,000 cars that drive by it.
Yep.
We have visibility directly from them. So this project is under construction. Same company that's building it for us here in Houston, I mentioned to you. We both know him, and they're building it for us. So that one is much farther out, expected to be completed by, Q4 of next year.
Okay.
But the parking garage is about 5.5 stories done. So it's really great to start seeing these things.
What do they call it, a 5/5? Or,
That's exactly right.
Right?
You got it, man.
Yeah.
So
I've done a little homework.
there you go. So in Dallas, started spending time there. This is our second project. We came across a site in North Dallas.
Okay.
Let me tell you, Purva, we fell in love, okay? And this is a 19-acre site.
Okay.
And initially we came in and we're like, hey, maybe let's do multifamily here, right? But we did the market study, and what really came back is BTR, built to rent.
Yep.
Right. And you're familiar, this is probably the hottest product in the market right now in real estate, specifically for institutional investors. Right. So we ended up, meeting with the city. The city loved the idea, and they basically gave us money for a PID. Are you familiar with that? A public improvement district.
Okay.
So as long as elements of the project are available to the public to use, they would basically pay and fund for all of the horizontal infrastructure.
Oh, that's awesome.
The streets, the sewer, the water, the lighting.
Great.
So we basically signed up with the PID, and as we were going through it, we got approached by a home builder. And they said, hey, we want to build all 225 of these. We'll just buy it out from you. So we are now under contract to sell them 225 single-family townhome for rent community, but the lots are all under contract to sell to them. So between these three projects, the garden style in Houston plus the two in Dallas, is about $168 million of projects there, right? And so that is the ground-up development side of our business, which is a different animal. We have a different team. Internally, we've created business units that manage each of these, and we have them essentially overseeing this. But as you can imagine, with the ground-up development, they have their own problems with, right? So, we really have learned a lot through these two development projects, and we continue to learn every single day. But even with all of these, it's important for you to know that we bring in kind of co-development partners, right? People who are overseeing as an owner's rep to make sure that the project is being constructed on budget, on time.
Right.
And, we give them part of the deal, right?
So you hit a great point, and I was going to talk about, walk me through the team infrastructure for MarketSpace Capital.
Sure.
First of all, where did you figure out how to navigate this org chart, right? As a new private equity firm, what research, where did you even hey, I need this guy, I need that guy, I need a capital markets guy, and those are all things that a mature company kind of understands, but somebody new, and again, kind of my audience for this show is really up and comers. Okay, let me learn, share the war stories, so maybe, or the door stories, as they call it, right, is what we're calling it. So that way somebody else can save themselves maybe some heartache and some headache and maybe some money. But yeah, how did you make up this team?
I would say it's simply out of necessity.
Okay.
Right? Because as you grow, you realize that you can't do everything yourself.
Right.
And we know sponsors that do everything themselves. They won't use legal, they'll review all the legal docs. So, while in our closing statement we had $60,000, $70,000 in closing costs for legal, they have 10, right?
Yep.
But man, we pay because I want someone to look this stuff over, right?
Correct,
Who knows what they're doing.
And you've got some great LPs. You need to protect them, right?
Exactly.
At the end of the day, that's what it's for, right?
Exactly right, man. And so, so we, out of necessity, we built it up. First guy I brought on was someone who could do the financial models, because that's the most important, who has experience in the numbers, right? And that's not my strength. My business partner, David, that is his strength. But even to that degree, we need someone to challenge him, right? So we brought on someone who has a lot of experience with that. And then from there, as we grew, we knew I always kind of oversaw the equity raising side. But even today, I can no longer do that. So we brought in somebody specifically to oversee that side. Market data, right? And understanding. So we basically created an econometric model, which is just a fancy way of saying we take 27 pieces of data, right? We want to say we're very data driven. So, initially every sponsor looks like population growth, all of that stuff, but we get into crime rate statistics. That's really important to us. Education grades, right? So 27 different pieces of data. They collect that. And they basically, it's kind of selfish to a certain degree, because we don't want to spend unnecessary time, resources, or money on a project that doesn't fit those parameters. So immediately it's just the research to do that. And then we know that by the time it's come to our investment committee, that it's gone through all of those things, and that it's exactly what we're looking for, right? And to your point, we don't want to be all over the place. So that's why I'm not really investing in Class A assets, 200,000 per door, unless there's a really compelling offer that came our way, we typically wouldn't look at that. We want to be in that Class C to B conversion range, right? And it's very cookie cutter for us when it comes to that process.
Love it.
But to answer your question, I mean, we're not the smartest guys in the room, but we want to be surrounded by them.
Yeah.
So we, on the
Beg to differ, but okay.
on the development side, man. So we'll bring in someone who has construction experience.
Yeah.
Right? He oversees all of our Dallas operations, and he knows what the construction components look like.
How big is the team today?
So in-house, in terms of like the private equity side, we have about 14. And then, when it comes to crews and maintenance guys, I mean, it's about 113 people.
Okay.
So
Are those subs, or are they like fully on payroll?
No, so some of them are on payroll, right? We
At
have
the
a core team.
respective complexes.
Exactly.
Makes
We have a
sense.
core
Yeah.
team, and they're on payroll there. So you can imagine our payroll.
An average apartment complex, how many bodies full-time do you typically have?
So it depends on the size of the complex, but I'll tell you the average
Like a
should
rule
have
of
about
thumb?
4.
Okay.
Right? And that's usually like a leasing person, that's a management person, then you have 2 maintenance guys.
Okay.
That's 4. But it depends on the size of the property.
Right.
Some of ours, like that one I was telling you about, the 464 units, we have about double, right?
Of course,
8 people there just
So
full time.
the rule of thumb, like 2 to 3 per 100 doors, 200 doors, something like that? Is there like a formula?
No, I would say for every 200 doors, you basically are going to want 4 people,
4 people.
right?
Okay.
Because even on our 122 unit that I mentioned near Fort Worth, man, that is an amazing property. We have 3 people managing the entire thing, and we don't really need a leasing person.
Yep.
So that's kind of eliminated.
Yep.
So you're just really focused on a maintenance guy and then someone who's managing the property.
Right.
And I'll tell you, for the future of this, my friend, is gone. Right? Like what I see our business going to in the next 2 years is that we're going to phase out the leasing office entirely. Our idea is that everything should be, if you have an issue, submit a ticket.
Yep.
Right? And then that ticket, we're going to have someone offshore.
You beat me to a bit of a punch.
Sure.
So we have 5 full-time BAs now.
There you go.
Right. And so, but before that, data technology, you guys are clearly very enabled. What's hot, obviously, right now is AI.
Yeah.
Right. What do you see? What implications? Have you seen use cases? Have y'all tinkered with this yet? Everybody should at least look at what ability to impact their business, right?
Yeah.
Irrespective of what business you do,
Yeah.
right? There's I think we're so early in AI, we really don't even know the scale of what it's going to do to industries, right? But have y'all looked at any of this stuff?
Of course. So again, in the conversation of driving our team to create revenue streams where otherwise they didn't exist, the same thing is on how do we reduce our expenses
Of course.
and bring this down. So first and foremost, let me tell you that collecting the data is the biggest issue.
Of course.
Besides me going and implementing a full ERP system, it's right now is really hard for me to track. So what we did is, okay, for example, leasing activity, everything that's happening on a per property basis, that's one data source.
Yep.
Okay, then I have CapEx going on, all of our construction, how many units are we turning? Okay, how much do we spend per unit? So that's one data source,
Yep.
right? So all of this has to be put into a dashboard where it's really easy for me to see.
Yep.
So right now we're going through that process, right? We've brought in someone who used to work at IBM specifically to kind of provide a visual component to this.
Okay.
We're using a system called data rails, right?
Okay.
So we take all these data from these different sources, data rail puts it into this one thing, and they create a customized dashboard that I can log into. They can show me everything from hey, payroll from this is due today to debt service.
Yeah.
Because we
Love
take
that.
everything that puts it in there, right? So we're working on all of this, okay? But to the next point, AI should be a part of everything that we do, right? In
Right.
terms of a ticket coming in, when we know someone is complaining, it's going to be usually about something that needs to be fixed within their thing, or something about their rent, right? But all of that can be substantiated down to 4 or
Structured
5 different responses.
Data points, yeah.
And then you basically have an AI that responds to that. Only when that can't solve it, it gets escalated, goes to a VA. But every part of this, if you live in an apartment complex at our thing, I want it to where first when you want to go see the apartment, you come in and you make an appointment. When you go to see, when you arrive at your appointment time, you scan your QR code, it opens the door. You go in, you get to see the unit, it looks beautiful. You get out, you want to sign the paperwork. It's all done through DocuSign online. Now you do that on this day, it tells you your unit's going to be available, and this is when you can come pick up your keys. You go and it's a seamless process, right? They come in, they move in on that date. If something goes wrong, they submit a ticket. That ticket goes through AI, should be solved initially.
Yeah.
If it can't be, then it goes to the representative. That representative follows up with them, make sure that it gets fixed. Once it's fixed, you follow up and you say, hey, how did it get fixed? Rate me. Now submit a Google review.
Yeah.
Right? Now here's something for free. Submit a Google review and here's a free t-shirt.
Yeah.
That is the vision that we have through the entire process. But of course, it's going to take time. And note that, some of our Class C assets, it's much more challenging to implement some of those technology-enabled solutions.
Right. Right.
Whereas in our ground up development, our spot at Anderson, the 155 unit here, man, it's gonna have solar on it, EV charging stations. It's gonna have the works, digital thermostats,
just modern,
with all
completely
of this.
modern. Yeah,
You got it.
I love it. Yeah, so it's interesting. For example, our storage facilities are Class C, right, for the most part. And so I completely agree and concur. Digitizing the experience from customer service to onboarding, offboarding, it's a little tricky. But I think that natural language bridge that now is coming with the AI, I think that conduit is probably all that was missing, right?
That's exactly right.
So for example, we're now shifting our communication endpoints to our customers or our renters is all going to be through WhatsApp. And so then you build in a ChatGPT or whatever you want to call it, conduit, and it can start engaging through WhatsApp, right? So they're talking to our facility, but it's all WhatsApp, just kind of using data that we've structured to some degree to give them the conversational endpoints, right? And in our world, there's only a limited amount of outcomes that can happen, period. Yeah. But I think it can happen, and it can be transcribed into other languages. So whether they're different culture communities, whatever, it can happen. And I'm like, whoa, this is scary and also cool at the same time, right? So I think it's going to be interesting to see. I love to kind of watch y'all's journey as you start to adopt and see what happens, right? I'm not going to be ignorant to think that we're the only ones thinking this way. There's people that are really smart that are already tinkering and figuring it out, right? But it's going to be really interesting. All right, so let's kind of, first of all, thank you for all the journey you've already given me. Let's talk about where you guys are headed, right? You're kind of maturing these different sides of the business, right? It sounds like multifamily is going to be the core of all things that you guys are doing, but maybe there's other kind of layers underneath that you can, it sounds like you're looking at your P&L and saying, hey, how can we optimize all these line items? The energy you mentioned, the staffing is going to be another layer. There's going to be all these kind of optimizations, and those may stand up different revenue streams for the company as well, right? But where are we going? What's the next?
So I'll tell you. We covered our two verticals of our business in terms of the value add strategy as well as the ground up strategy. I will say that the mixed use particularly has one enormous project that
the shopping mall. We haven't even talked about the shopping mall. Tell me about the shopping mall.
Yeah, so basically we came across through a connection of ours, a broker, of a defunct shopping mall in Cincinnati, Ohio. Okay. And basically, we came in and saw it, man. We fell in love with the opportunity there. We're buying it at a very low cost basis. And, this mall is going through what all shopping malls across the country are going through. And imagine in 2007, they had 98% occupancy. When we acquired the mall in March of 2022, it had 18% occupancy. Wow. So the former Sears, Macy's, Dillard's, JCPenney's all shut down and close up shop. So, there's usually two problems with these acquisitions of Porvo. Number one is that there's a number of different owners involved, 8 or 9 different owners that you're negotiating between to try to get this. In this case, there are 3 owners. There's the Macy's building, the Sears building, which Sears is very difficult to work with. And then and you would think, this is a chain that's going out of business all around the world, but you think
they might not think that, but sure.
But and then
blockbuster guys, right? So our mindset.
Yeah.
Okay.
And then the third one was a Chinese company that actually bought the mall back in 2011. Okay. So we negotiated between all 3 of them, and we took control of 75 acres of land. Wow. And in Provo, they say that if you're looking for good real estate, look no further than shopping malls, right? Because they're strategically located, and they have the ability to capacitate large crowds, like during the holiday season. And this mall is no different. It has 2 structured parking garages totaling 3,500 parking spaces, right? And with all of the surface parking and the structured parking together, it has 7,000 parking spaces. Wow. Right? So we have this giant mall there, right? And so the second thing that we look at when we look at these malls is that they already have typically a large saturation of residential surrounding the mall. Think of West Oaks Mall, right? And so it doesn't make sense for us to come in and repurpose it for multifamily because we're not gonna get the rents, right? In this case, it was different. The city that it's located in, called Springdale, which is 17 minutes north of Cincinnati, Ohio, they basically got screwed over by a multifamily developer in the early 90s. So they passed a moratorium where they didn't allow for any new multifamily development. So for the last 30 plus years, they have not had a new apartment complex that has come up. So it's created this pent up demand. And so the city did a study, and through that study, they basically entitled us for up to 2,600 multifamily units. And so as you can imagine, we have basically come up with a site plan to repurpose this shopping mall and to make it a mixed-use development with a very heavy emphasis on multifamily development. Now, the two biggest things that drew us to this, you might be asking, why are some developers out of Houston, Texas, setting up shop and going after a project in Cincinnati or Ohio? Are you crazy?
Right.
And yeah, you might think so, but there's really two drivers here. The first driver is, of course, the very low cost basis that we bought this thing for. We bought it for half the cost of what it sold for back in 2011. And so we just got in at a very low basis.
Right.
The second reason is because from the very moment that we stepped foot in Cincinnati, we met with the city mayor in Springdale and everything. It was clear to us that they were desperate for someone to come in and repurpose this mall. So they, no developer would come in to spend the money to do the streets, the sewer, the lighting, to redevelop into a mixed use, because it just keeps you in the negative, right?
Right.
For this reason, the city said, okay, we're going to offer you tax increment financing.
Yep.
So they basically have approved us for $200 million of tax increment financing to be used to repurpose this mixed use development. So that is the reason why we went after this project. And in March of 2022, we acquired it. In May of 2022, we shut down the mall. It was losing about $2.5 million per year.
Wow.
We shut down the mall, stopped the bleeding, right?
Yep.
Then we've signed our development agreement with the city. We have community entertainment district. We have all of the Fedora. We got all of that stuff done, and we've now finalized our site plan. The idea is we're taking out the parking lot, and we're basically converting it to what we fundamentally believe, Apurva, as the prototype of what these mall properties are going to evolve into, which we believe are like lifestyle shopping centers.
Got it.
A place that you want to take your family to on a Sunday afternoon, place you want to go watch the 4th of July fireworks, that type of thing. So we've basically stripped a lot of the parking out, and we've created a large green area. On one side is a public stage, on the other side is like a splash park for kids, right? The entire mall itself, initially we were going to do select demolition, where we keep parts of the mall and repurpose that into an actual residential.
Yep.
And the first floor is going to be retail, the second floor, living, second and third floor is living.
Yep.
This all changed when a major grocery retailer came in. Okay? They basically came in and they said, hey, we like where the former Sears parcel is. We'll take it as is, where is. So now that we're giving up 12.5 acres to this major grocery anchor tenant, we are limited in the density that we're able to get from the existing infrastructure that's in the mall.
Makes sense.
So the decision was made, instead of going with select demolition, which was costing us around $22 million, we're now moving forward with full demolition, which is around $9 million.
Oh, wow.
So we're saving a bunch of costs.
Yep.
And now as we're rebuilding, we're able to regain the density. Imagine we're like a Foot Locker. That was one of our tenants. So if you're reconverting the Foot Locker into a multifamily residential unit, it's really hard to do so.
Correct.
Now we're able to do so, and we're regaining that density. So initially by doing the select demolition, our unit cost was coming out to like $280,000 because we're only getting 480 units. Now we're able to get like 800 units, and our unit cost is coming out to like $170,000.
Oh, that's awesome.
So this is a really exciting project in our portfolio. It's the largest one. I mean, this is $1 billion redevelopment if you look at it through all 5 phases of development.
Yeah.
I'll tell you, Apurva, what we are is the master developer. We came in and we basically partnered with co-development partners to take on different components of this project.
Yeah.
So, for example, the hospitality. We're not in the hospitality business.
Right.
So we went and found a company locally that is. They have 21 hotels. They did a market study, came back as like an A-loft style hotel, would fit really well there.
Right.
They're going to build it. They're going to develop it. They're going to manage it.
That's awesome.
All we're doing, and you can imagine our value out here, phase 1 was just the acquisition, getting the entitlement, zoning, all the development agreements. Phase 2 is, as you can imagine, everything is on one 75-acre parcel. We have now split it up into 27 different parcels.
Got it.
Okay, and so all of the street, sewer, water, lighting is now going to be redone to those 27 different parcels.
Got it.
So once the infrastructure work is completed, I'm basically unlocking those parcels, and then we're selling them off to other co-development partners. In some cases, we're partnering with them, right? Where like the multifamily and the retail, we found this big player in Columbus, Ohio that we really like. So we're going to partner with them 50-50 on the deal, right? We'll raise some of the equity and stuff. But we still get the step up in basis from the original land, right, to where it's at today.
Yeah.
So as you can imagine, Apurva, when we went to our investors, this is a really hard project. It was an empty shopping mall, right? So we raised money on a preferred equity structure. With the idea that a reverse dilution happens in the future. So at some point when we get our construction loan around this October and we move into that next phase, we offer all of our investors a redemption option. And we say, hey, you can take your money with your step up in basis and go, or if you want to avoid a capital gains event, you can redeploy that capital into the next phase of the project.
Makes sense.
So this is, again, the biggest project in our portfolio. We've been
love
spending
it.
a lot of time in Cincinnati. I'm there once a month. We have a house we rented there now.
That's awesome.
I mean, so this is a really big.
So you hear about purely land developers that'll come in, take down 100 acres, 1,000 acres, whatever it is, and then they work through all the entitlements, right? This is effectively the same play, but on steroids,
You got it.
right? And it wasn't intended that way, but it turned into that. But it's not it's not easy, and I definitely don't want to take away from how complex that is. It's a lot.
Yes.
I mean, just thinking about what we did to just do one tiny development, all the brain damage that I had to go through. So I can only imagine the exponential version of that. But yeah, I mean, that's really what it is, right? You just took a great parcel and have come up with a new play. You worked hard to get the entitlement parts done. You worked with the city, got some kind of advantages to do so, and got some blessings from all the players and stakeholders. And then you said, hey, now I'm just going to chop this up, and we're going to make some money that way, right? And move on, maybe stay in some of it, whatever, right? I love it.
Yeah. And then the beautiful thing about it is that we've given our investors a investment vehicle, a long-term investment vehicle that avoids capital gains.
Yeah.
That allows, so from the very beginning, they can invest. And 10 years later, once it's done, they'll have seen it every single part of the way. They get
keep
their
rolling
bases.
in if they want to. I love it. All right, so sorry, we segued to we had to talk about the mall. I wasn't going to let you leave without talking the mall. Let's just round this thing out. What is the next 3 years? What is the next 5 years? Where are you guys headed?
So I think it's important in today's market conditions that we really protect our portfolio. I'll say that because we just went over the rosy stuff, right? We didn't even get into the nitty gritty of the difficulties that sponsors such as ourselves are facing, and the gun that we have to our head with these high interest rates, right? All we can do is continue to monitor that very closely. I mean, yesterday's figures showed a modest increase in the inflation numbers, so kind of going the wrong direction. But that's attributable to a lagging indicator of housing data. But ultimately, we see ourselves as interest rates kind of stabilizing. We're probably in the worst of it right now.
I hope so.
We think that by next year that this will start leveling out. Now, it's never going to go back to what it was in the past, but we do see it coming down from where it was today. And I even think the last increase that the Fed did was kind of extra burden to pour that last bucket of water on the fire just to make sure that everything is out, right? And then as we move into the next quarters, we'll stop and then we'll start tapering down. There may be one more increase that they're projecting for that
heading on an election year, there's going to be some stuff.
Exactly. We're battling through all of that, but the good news is that we see the light at the end of the tunnel, right? Like all of our properties are, thank God, in a place where we're, going out of that high interest rate into a fixed rate. What's beautiful is for our product, like in the multifamily sector, is that there's a lot of affordable interest rates and lending available. Whereas in office, it's dried up, man. If you want to buy an office building right now, it's very difficult to get a loan. But whereas in multifamily, everyone needs a place to live, right? And I always say it's easier to get a butt in a bed than it is to get a business into a retail shopping center, right? So that's where we're at, man. So holding on, protecting our portfolio. We see the market slowly tapering off. I think everyone is stay alive till 25. I really see that as a probably
a mantra to live by right now.
But ultimately, it's protecting our investors, like you said, making sure that at the end of the day, man, we're the stewards of their capital. These are people's life savings that they're putting with us. So I remind my team of that, at every chance I get, because every dime that goes out of our office, man, I have to speak for it and speak to. Understanding that we just move forward and try to be responsible and again surround ourselves with people that are a lot smarter than us to make the right decisions.
I love it. Give me a quick couple lines for somebody that wants to get on a similar journey. Where should they be spending their time? Give me some advice. Fresh out of college, I want to get into real estate, specifically in the private equity side of the business. What's some advice you would give to somebody?
Well, first and foremost, I would say that start by getting some experience in a PE shop and understanding the different, mechanics of it, because at the end of the day, they might not even realize that they don't even like the business, right? I mean, there's some elements of it that are really tough to deal with, right? The property management side of the business, things like that. But having a vision in place, the first thing we did with MarketSpace Capital, we sat down and we're like, okay, what does 1, 3, and 5 years look like for us? What are some goals that we can establish along the way? And I'm proud to say that we're like every quarterly meeting that we have, part of our agenda is like revisiting that 5-year strategy and seeing if we have to make adjustments to it. And then honestly, every intern class we get, we make them spend some time on it,
There you go.
updating and stuff, you know.
Love it.
But we've been able to hit and surpass all of those goals that we've been doing. And I think it's because like we document everything and we really try to understand it. And like Apurva, we didn't even get into tokenization.
Yeah.
Like, we have as a sponsor, we've tokenized the very first ground up development
Oh, wow.
project in the entire country. And that is the project in Dallas, the spot at Meyer Park, the 250 unit.
Yeah.
We took the $9 million of LP equity that we raised through there and we went and tokenized all of it.
Oh, that's awesome.
But we spent a year and a half researching this. We spent a lot of money with legal, accounting, and understood the different implications and decided to use this Meyer Park as a case study to tokenize. So all of those investors have basically a digital wallet with us, and their tokens, their 50,000 tokens, for example, if you made a $50,000 investment with us, each one token we use a stable coin, so there's no fluctuation or volatility.
Right.
So now, if you made a $50,000 investment with me, you sign off on the same documents, except these are smart contracts.
Yeah.
And then to your digital wallet, you get 50,000 tokens. Now, after 12 months, Apurva, you have the ability to go trade those tokens on a secondary market. And so basically, it's allowing liquidity in a investment that is otherwise inherently illiquid.
I love it.
But moving forward, when I'm doing distributions to investors, imagine I can remove banking institutions entirely.
Yes.
And now I can essentially issue to your digital wallet. So I'm sorry.
So the advice to the rookie that's coming through is going to be like, get your blockchain like skills on point, because that's where we're headed.
I think that's part of that is the future.
No, you're not wrong.
But we don't know what element yet. And I'll tell you, even we're doing the investment that we made to this, we're kind of doing a cost benefit analysis to see if it's even worth it. Right?
Sure.
Because the amount we spent compared to the transaction and volume that's going on, we're not seeing there. Right?
Of course.
But we wanted to establish ourselves as an authority.
That was our R&D play. Learn it, figure it out, and decide like, hey, does this have legs, and does it give value? Ultimately, does it translate into value for LPs long term? Right.
That's it.
So you pay the dues, put in the hard work on the front end, but down line it can pay significant dividends, and maybe a new standard by which LPs look to invest.
I really think it is.
I mean, I love that.
Yeah.
Love that totally, dude. This has been great. I'm gonna round us out. Thank you for taking the time. I'm like, just my wheels are turning, my head's spinning, but all for good reasons. Because I mean, you've figured out so many layers to what real estate investing is, and different ways. And honestly, anybody kind of backing into like somebody new, like look at all the layers and angles you could come in, right? If you want to get on the tech side, y'all are playing with 3 to 5 different things of just technology related kind of opportunities. If you want to get into property management or the construction management, there's ways to get into this business that aren't necessarily like, oh, let me buy a rental property and start real estate investing.
Yeah.
Or like the sophisticated guys that are high earning already, be exposed as an LP, right?
Yeah.
That's a great way to be part of the game, but not have to be lifting all the fingers and doing all the heavy lifting. They partner with great guys like you that run impressive shops. So thank you for the time. It's always a pleasure to see you. It's been way too long. I'm going to do a follow-up with you because I want to see some of these projects. I want to see what happens with the mall a few years down the road, some of these ground ups. Like, let's see where we're at. I want to circle up in a year or two and check back in.
Thank you, man. I mean, you have been kind of the pioneer in our community. I follow you on Twitter. I see you on LinkedIn. And that's what kind of gave me the motivation of even getting into real estate. So it's partners such as yourself and other people we know in our community, man, that have allowed us to achieve some modest level of success.
Dude.
So I thank you for allowing me to be here today and spread some of the trials and tribulations of our industry.
They say the rising tides raise all ships, right? I consider myself a puddle, but still, like, you guys are starting to become the ocean. So I love it, man. Keep at it, brother.
I appreciate it. Thank you.
Appreciate it. Yep.
All right, sir.
Perfect.
Boom.